Incentives for non-employees. Why would a company want to reward non-employees? 20 years ago, with a few exceptions, you either worked for a company, usually full-time, or you didn't. With the exception of the occasional non-executive director, it would have been considered very odd to grant options other than to employees. Since then, the expansion of portfolio careers, service companies, advisors and consultants has made many businesses realise that non-employees are vital to their business and to try to devise ways to incentivise and retain them. Unfortunately, the legislation has not kept up with changing work patterns, and the principal tax-advantaged share plans, such as EMI and CSOPs, are not open to non-executives or other non-employees. So what is available for non-employees? Advisors and other non-employees can be granted options over shares in the same way as employees, although this will generally not be as tax efficient as the tax advantage grant to an employee. The option agreements will be very similar, although of course the eligibility requirements and leaving provisions will need to be amended to reflect the terms of the consultancy. For example, if you bring in someone to do a particular project, it would be a bit tough to treat them as a bad leaver and cause their option to lapse if they stop working for you once the project was finished on schedule. It would be equally odd for someone to remain on the books as a notional consultant and continue to accrue shares even though their services had not been called on for some time. These matters can all be addressed in the option agreement. Another possibility is for the advisor to acquire shares in the company. Sometimes these shares will be provided wholly or partly in lieu of fees, and this needs to be reflected through a more generous vesting schedule. If the share value is very low at the time the advice is commissioned, payment through shares may be attractive to both parties. You can take this too far though. At the height of the internet bubble, it was reported that Silicon Valley barbers wouldn't take cash for their haircuts, only stock in their customer's company. What are the disadvantages? A major concern for a company that engages advisors is always that HMRC will look to treat the advisor as an employee, which would create problems for the company because of the PAYE and national insurance withholding required. This is a particular issue where the advisor has no other clients and spends the greater part of their time working for the business. The grant of an option is considered by HMRC to be a strong indicator that a person is an employee, so it is best avoided in a situation where the employee, non-employee status is otherwise finely balanced. What is a non-employee's position with regards to tax? Because advisors aren't eligible for tax-advantaged option plans, their position will depend in part on how they make up their trading accounts. In some circumstances, options may be granted to a service company rather than an advisor, though this can give rise to its own problems where the advisor extracts cash from the service company. The easiest solution may well be the simplest. That is for the advisor to become a shareholder in the company early on when the shares have a low value, but this depends on the specific circumstances of both company and advisor. How can we find out more? If you'd like to find out more about what kind of share scheme might work in your company, we have a number of additional short animated tutorials that will give you the information you need. Postlethwaite are a law firm specialising in employee share ownership. We are employee owned ourselves. Get in touch.